Thank you so much. I'm going to spend a little bit more time before we get into the content of our talk today, just by way of introduction of who I am, the credit union system, as it said in the introduction you just provided for me, that I'm very passionate about it. So I'm just going to really briefly touch on it quickly here at the beginning. The biggest difference between the financial institutions of the top 5 banks and how credit unions are structured are ownership. So the people that own the credit union are the people that do the banking at the credit union. We offer the same products. We offer the same support for mortgages, investing, small businesses. We do all of the same things. But our structure is different. So we are owned, and even our CEO takes orders from our council, which is made up of the owners of the credit union. That's important because, like it said in my introduction and my bio, I have worked at a number of different financial institutions, and I have chosen to hopefully have a long and profitable career with Libro Credit Union, precisely because the structure that we have, where the people that we serve are our owners, allows me to make the best decisions for the person sitting across the desk from me. And that was not the case at the other financial institutions that I have previously worked at. It's a very important distinction, and I wanted to touch on it today. It's also the reason why doing community outreach and helping educate people on their finances is such a big goal that I share with Libro. One of the biggest reasons why I'm very excited to be speaking with you all today. We're going to tackle 2 different focuses for understanding your wealth better. The first one is going to be different types of investment products that you have access to here in Canada, and how to invest in them. We're going to cover off the tax implications of these products. There will be some questions that I ask throughout this presentation where I'd love to hear a hand raised or some feedback coming off of the mute, but we will save the majority of your questions to the end of this presentation. The other piece that I really wanted to focus on and spend a bit of time on today was about credit ratings, credit scores, utilizing credit, maintaining your credit, repairing it if it needs that, and why credit is so important to the financial systems in Canada, and why it's so important to you as an individual taking part in our financial systems in Canada. So we're going to start off with the difference between RSPs and TFSAs. We're going to talk about the benefits of using RSPs and TFSAs, how to decide whether to invest in an RSP or a tax-free savings account, or both. We're going to talk about the different types of RSP and TFSA products that you can invest in, and much more today. And again, there's no sales pitch here. This is an educational piece. What is an RRSP? An RRSP is a registered retirement savings plan, and it's one of the best ways to save for your retirement. I'm going to deviate from the script in a lot of places here today, but here's the first one. I think RRSP is a bit of a misnomer. Because what an RSP does is it defers taxes. I would much prefer if we called it a tax deferral plan. It is not only for retirement. What happens is when you make a contribution to an RSP, you get a tax deduction. You want those tax deductions on your highest income earning years. And then when you pull money out of your RSP, you pay taxes on those withdrawals as though it was income. The reason why I say it's a tax deferral plan is because there might be opportunities where you take time off of work for whatever reason, where you're going to have a year where you have very low income. And that is a great time to access your RRSPs, as it's probably the most tax efficient time to access those funds. You don't want to be pulling from your RRSPs when you have a lot of other income. And when people are in retirement, there are government benefits and many other sources of income that you may have access to. that will increase your income level, and then your RSPs get pulled on top of that. And the most tax efficient time to pull from your RSPs is when you have low income. So let's keep that in mind as we call it the Registered Retirement Savings Plan. My preference is to call it a tax deferral plan to when your income is low. The benefits of an RSP, we've covered off some of these already, but you pay lower taxes right now. So if you're making a salary of $60,000 and you contribute $5,000 to your RRSP, we'll go through some more of the math later on as well. You get a tax deduction based on the amount that you contributed. Within the RSP, once you make those contributions, it can grow tax-free, which also means you get the advantage of something that we financial advisors are very passionate about, which is compound growth. You don't contribute and then pay taxes on it, contribute, pay taxes, contribute, pay taxes. You contribute and then you earn interest, and you're not paying taxes within the RSP, which allows you to grow your finances based on not just your contributions, but all the previous year's growth combined as well. It can become a very significant driving factor to the growth of your wealth over time. There are also other programs associated with the RRSPs, like the Home Buyers Plan, or the Lifelong Learning Plan, or the Spousal Plan, that allow you to access funds from your RRSPs without tax implications to do things like purchase your first. Okay. Again, so sorry about that, that break there, guys. The way the contributions to the RSP work is if you contribute $1,000, your tax refund on that contribution is about the taxes that you would have paid in your marginal tax bracket for that $1,000. So it's not the full $1,000 that you get as your tax break, but it is it can be probably the most significant tax savings that you have available to you in any calendar year for the additional contributions you make to your RRSP. The next benefit here is tax-free growth. The interest you earn within your RRSP is not taxed until you cash it in, as we discussed with the tax deferral instead of the RRSP name. Most people cash out their RRSPs when their income is lower, and they pay lower taxes on the contribution and the interest. Third benefit, Home Buyers Plan. You can now withdraw up to $35,000 from your RRSP with no tax penalty to buy your first home. It does have to be your first home that you're purchasing. This is for every individual. You have 15 years to repay it with no penalty. This is structured not as an RRSP contribution, but as a repayment to yourself over 15 years. And if you took out $15,000, you split that up into 15 equal parts and you repay $1,000 to your RRSP per year. Okay. All right. The fourth benefit to the RRSP, the Lifelong Learning Plan. You can withdraw up to $20,000 for educational purposes from your RRSP with no tax penalty. It can be used for yourself or your spouse or your common law partner. And instead of 15 years, you have 10 years to repay this back into your own RRSP. It's a great way to get access to funds from your RRSP without tax implications for your first home or for some education. And I would really recommend, if you want to talk about that with somebody, go in and start a conversation about the Lifelong Learning Plan or the Home Buyers Plan. It could be one of many great tools that you have access to tackle some of those goals. The fifth benefit, the spousal plan. A high earning spouse contributes some of their allowed contribution amount to the lower earning spouse's RRSP. One of the benefits is that when the money is withdrawn, they will pay taxes at a lower rate. We call this income splitting. This is a very good strategy for in retirement. If you make a contribution from the higher income earner to their spouse's RRSP, that higher income earner gets that tax benefit of reducing their income tax for that calendar year. Once the money is vested, it takes 2 years. Once that money is vested in the spouse's RRSP, when the money is withdrawn from the RRSP, it's withdrawn in the spouse's name. We usually utilize this tool for income splitting if there's a really good pension and we still want to make contributions to the spouse. We don't want to have all the income with one spouse because they'll be up in a much higher tax bracket. We want to even that out between the two spouses as much as possible so that their income in retirement is as tax efficient as possible. And a spousal plan could really significantly contribute to income splitting and keeping those incomes as similar as possible, because that's far more tax efficient than having one high income, which is at a much higher tax bracket, and one lower income at a much lower tax bracket. The reason why we introduced this concept, you don't have to be in retirement to be aware of this, is because this could be a good strategy that you employ right away, so that when you do get to retirement, that income splitting has had years and years to work and to balance out what your incomes are going to look like in retirement. It's a very effective tax efficiency strategy that I would encourage you guys to speak to somebody about as well. RSP products. Here's where we're getting into. So RSP, I like to talk about as the umbrella, or in my examples that I usually use, a bucket. You put money into that bucket. When you put money in, you get a tax break. It grows tax-free within. When you pull money out, you get that taxed as income. But while it's within that bucket, you can invest the money that you contribute to the RSP in many, many different products. You can invest it in a savings account. You can invest it in term deposits. You can invest it in guaranteed investment certificates, or GICs. You can also put it into mutual funds, stocks, or bonds. It is not a very restrictive space. You have a lot of options for how you want to drive the growth of your investments within the RRSP. Having a conversation with somebody about all those different options, what your risk tolerance is, what risk you're willing to take on, and how each of these will affect compound growth, and that sort of thing. That's a very worthwhile conversation to have. And that's one that should be unique to each individual. All right, so here's how we calculate your maximum RRSP contribution. There are two factors that go into it. The first is it is 18% of your previous year's income up until a top threshold of $27,830 in the year of 2021. That number, the $27,830, that changes every year. It goes up slightly, along with inflation and many other things. So keep an eye on that. It does change every year. But for most people, that 18% of the previous year's income, that's the number that we're looking at. That's what your RSP contribution limits go up to, or go up by, on an annual basis. The deadline to contribute for each year goes into the first 60 days of the next year. So for 2023, you have until March 1st of 2024 to make RSP contributions that will count towards 2023 or the previous year. So you've got a little bit of a window into the following year to make RSP contributions that count towards the previous year. Okay, that's important because most accountants will want to have that conversation with you, and it gives you a little bit of time to have that conversation with your accountant to decide what you're going to contribute to your RSPs to reduce your tax liability in the following year, right in around tax time. So here's a question for you guys. Before we've even talked about TFSAs yet, true or false, tax-free savings accounts are really for the rich and for people who max out their RRSPs. What do you guys think? Come on off mute and let me know yes or no. True or false?
False.
False. That is definitely the answer I was hoping for. Tax-free savings accounts are a wonderful, wonderful type of account. They are still relatively new in the Canadian space. They came in 2009. We have contribution room accrued for everybody who was already 18 in 2009 up until today, with contribution limits increasing every year up until this point. TFSAs have a lot of similar features to the RRSPs, but TFSAs are for everybody. One of the reasons why I really like talking about tax-free savings accounts in these educational spaces is because it is a relatively unique product to Canada. It's not unique in the world, but there's not a lot of places that have this type of product. And because it's so new, I think the financial industry has not done a really good job of teaching people what this is for and how it works to your best interest. A lot of the banks are still marketing the tax-free savings account as a savings account. Again, I'm not a huge fan of the name. Tax-free savings accounts are a great way to pair with pensions and RRSPs for retirement planning. They're a wonderful estate planning tool. There is a lot more to these accounts than simply a savings account. And we're going to get into that and learn a little bit more about that here now. What's a TFSA? Like an RRSP, a tax-free savings account is also a good way to save for retirement, but the way taxes work on it are very different. Here are some of the benefits of a TFSA. There's flexibility, there's convenience, they are very tax efficient, and they are non-disruptive. And we're going to go through and explain a little bit more about each of those benefits. So, for money pulling out of a TFSA, you can use that on any major purchase plan. It can be for a car, a house, education, vacation, bills, and any type of savings. So that's your flexibility. Convenience, you can withdraw from the TFSA at any time. Withdrawals make room to add again. When you pull money at any time in this calendar year from a tax-free savings account, you get that amount back in tax-free contribution room January 1st of the following year, as well as next year's contribution room increase. Okay, so if you pull 10,000 out of your TFSA, you're going to get the ability to recontribute 10,000, and probably based on inflation and what they've been doing the previous years, you'll get another 6,500 contribution room for the year of 2024 as well, January 1st. So it is pretty convenient. It's tax efficient. So when you make contributions to a TFSA, you don't get that tax break to your income, but they do grow tax-free within the tax-free savings account, which allows you to take advantage of compound growth. And when you pull money out, the withdrawals are tax-free. I really like to stress this point because in retirement, there are very few to no options for you to be able to withdraw money from where it is tax-free. Your RRSPs are taxed. Your government benefits like CPP and old age security, they are taxed as income. If you have a pension that you've been paying into from work for years, that gets taxed as income in retirement. What we want to do with all those fully taxed as income sources of income for your retirement is keep them low and consistent and steady as possible through your retirement. So when I talk about tax-free savings accounts and how they work with your retirement income, they are the buffer that allows you to keep your taxable income steady and stable, predictable, and tax efficient, because we don't want high years and low years. That's not tax efficient. We want it stable and consistent. The TFSA is my major purchase planning vehicle for retirement. If you need a new car, if you need a hot water heater, if you need to go on a trip once a year for $5,000, the TFSA is where you pull those assets from, where there will be no additional tax implication, and we can keep your RSPs, your pension income, all of that planned for and nice and stable and consistent. And if there's an emergency or anything like that, you pull a lump sum from the TFSA and you don't have to jump up to the next marginal tax bracket and pay more taxes. It is a very, very good supplement for major purchase planning for your retirement. So let's talk about that a little bit further. Let's say you have a very low income that you're expecting to take in retirement. If you have a low income for somebody in Canada, there are government programs that the government will help subsidize your income in retirement. A very significant one is called the Guaranteed Income Supplement, or the GIS. If your income is too high, they'll start clawing back your old age security, or OAS. You get an age credit, you can get employment insurance revoked or repealed. The Canada Child Tax Benefit also starts to be clawed back if your income is significantly high. Working income tax benefits and the GST and HST credits. These are all things that the government will provide you if your income is low. You can still pull money out of your TFSA, and it does not count towards that year's taxable income and will not disrupt things like clawing back your old age security or the Guaranteed Income Supplement for retirees. So that's another way in which it really works well alongside government programs that are already existing. Your maximum TFSA contribution. Okay, this is where things get a little bit interesting, because every year from 2009 until today, we have had as long as you were 18 at that point, in 2009, you get a different contribution amount for almost every year. You get $5,000 from each year between 2009 to 2012. Then you get $5,500 for 2013 and 2014. Then we jumped up to $10,000 in contribution room for 2015. What happened there was we had a conservative government come in and try to get everybody really excited about being conservatives. So they increased what your contribution room was for that 1 year. And then I think the Liberals came back in and said, no, we're not going to do that anymore, and dropped it back down to $5,500 for 2016, 2017, and 2018. And it has been $6,000 for 2019, 2020, and 2021. These contribution limits go up based on inflation, and they only go up by $500 increments. Now, that does not mean that we won't see a government change and some changes made to the way in which our lifetime contributions will increase moving forward. But as of this year, it's $82,000 because we got another $6,500 increase. No, now we're up to, it's higher than that now. Sorry about that. I've got some dated slides here, but add the last 2 years of $6,500 contribution room to that number at the bottom for the lifetime contribution room as of January 2021. So within the TFSA, much like the RRSP, you can have all of the same types of investment vehicles within the TFSA. You can have a savings account, term deposits, GICs, mutual funds, stocks, or bonds. True or false? If I withdraw the $25,000 I saved in my TFSA to buy a car, my old age security pension payments will be reduced. Come on off mute, and what do you think, guys? True or false?
False, I'd say.
That is correct. Yes. So the TFSA is great. Now, if you pulled $25,000 from your RSPs, first of all, you'd be paying taxes on it as though it's income. And second of all, it would impact your old age security payments, could impact your GIS supplements, all that good stuff. A great reason why lump sum withdrawals from the TFSA are non-disruptive and work really, really well with your other sources of income in retirement. So that's a good review. Thank you very much. Now, we're going to spend not too much time on this slide because we've gone through all of these differences previously, but RSP and TFSA investment vehicles, all of your investment vehicles are pretty similar. You can even have a normal savings account in your RSP, just like you can with a TFSA. One of the concepts that I would like you guys to be thinking about is the benefits of compound growth, where you're earning money on last year's interest that you earned. That accelerates with the higher return you get out of previous year's returns. And by that, I mean, if you're getting 6-7% from a mutual fund or a bond every year, that is going to accelerate the effectiveness of your compound growth much faster than if you use your TFSA as a savings account, which they're still marketing it as in a lot of the banks. You want those higher rates of return. You want more efficient options for your investment vehicles within the TFSA and RRSP, so that that compound growth has the ability to have a greater effect over time. That does mean for most of those investments that you're taking or getting a higher interest or getting a higher return, it does require more complexity and, generally speaking, a higher amount of risk. But if you have a long time horizon, it is something to consider that that compound growth works much better with those higher rates. So tax-free savings account versus an RRSP. Let's just sum it up here. This is a great slide. Contribution is tax deductible. For the TFSA, no, it is not. For the RRSP, yes, it is. When you withdraw money from the TFSA, it is tax exempt. Yes, it is. With the RRSP, no. When you pull money from the RRSP, you pay taxes on it as though it is income. Your spousal plan. There is no spousal plan for a TFSA, but every individual has the ability to open up their own TFSA and get the benefits of the tax implications on that. For an RRSP, yes, you can have a spousal plan, which helps you to equalize or balance out your taxable income levels in retirement. For the TFSA, it does not need to be converted at 71. For an RRSP, it does. I'm going to spend a little bit more time on that as well. For RRSPs, the government says we gave you tax deductions for contributing to the RRSP for years and years. We also let your assets within that RRSP grow tax-free. At some point, the government wants their tax money back on that, so they make you convert the RRSP into a RIF in the year you turn 71. That RIF has specific rules, which means there are minimum amounts that you have to pull from the RRSP every year from 71 on, and you have to pay taxes on those withdrawals. Those withdrawal amounts go up by percentage every year until when you're 95, you're up to 25% of the amount that's within your RIF has to come out because the government wants you to pay taxes on all of that great RRSP money that you've been able to accrue over the years. That's why it converts at 71. Let's have another question. True or false? With interest rates low historically, it doesn't make sense to invest in the TFSA since there won't be any interest to get tax-free anyway. What do you guys think?
I think it's false because you need to invest on TFSA.
I would agree. I think it's false. It is important to invest in your TFSA, and the options for investments within the TFSA are not all tied to rate. Now, this again is a little bit dated as the interest rates have gone up quite significantly over the past year and a half, and you do get a better return out of things like GICs and bonds, which will allow for that compound growth engine to really kickstart and drive forward. You don't need to take a huge amount of risk to get some of that compound growth engine going within your tax sheltered environments of the TFSAs and RSPs as of right now. I've been talking about compound interest the entire time so far because of the tax sheltered qualities of TFSAs and RSPs, but we're going to talk about it with a detailed example just to drive the point home. Let's say your initial investment is $1,000, your annual contribution to that is $1,000, and your interest rate is 1.5%. You've invested for 30 years. With compound interest, your total invested is about $31,000. Your total savings is $39,166 at 1.5%, and the interest earned is about $8,166. Let's go to the next slide here. Now, let's say we've got an initial investment of $1,000, annual contribution of $1,000, exactly the same as before. Instead of 1.5%, we're at 2.5%. Not an unreasonable rate of return on most investments. You invest that for 30 years, same as the previous example. Total amount of investment is $31,000, again, same as before. Total savings is $46,220. The interest earned is double in the previous example, and that's with just a 1% change in the interest rate over that time. This is just to drive home the importance of even a 1% change in the interest rate can, with the power of compound growth, make a significant impact. True or false? If I start putting my money into my RSP when I'm 20 years old, then stop, I'll be better off than if I wait until I'm 35 to start, even if I put in more money annually. What do you guys think?
That's true.
A hint
I
here.
say true
You're
because of the compounding effect.
yes. Perfect. So that compounding effect, if you start later on in life, and even if you're starting later on in life and putting more in, trying to catch up, the people that started earlier with smaller amounts of contributions, they're still going to outpace you because compound growth has allowed them to earn money on the money they contributed 10 years ago, every year for the preceding 10 years. So compound growth is a very important engine that we try to talk about when you're in a tax sheltered environment at every opportunity. Let's skip past, I think you guys understand the concept of compound growth. And we're gonna just move past this because we've done a couple of examples already. Next steps, I really want to encourage you guys to go in and talk to a bank or a credit union about a concept or two that you've taken from this example. I would really encourage you, again, please speak to a credit union. It doesn't need to be Libro. I'm not here to sell you anything. I do encourage you to go and speak to a credit union because of our difference in structure. Any credit union, because we're all structured differently than the banks. When you go into a bank, they're trying to make money off of the people that bank there to pay the people that buy their stock. They're going to pay out dividends for their shareholders. You are the shareholder at a credit union. We're not trying to make money off of you. What we're trying to do is help you build your financial resilience. We want you to be profitable. We want to grow that prosperity in the communities in which we work. It is a different structure. And the practicality of that is when you come in and sit down with somebody at a credit union, you're going to get a coach. You're going to get somebody who's going to be genuinely interested in who you are, what your financial goals are, and we're going to come alongside you to help you reach those goals. That is not always the experience you get at other financial institutions because they're there to sell product and make money. Based on the difference in structure. It does not mean that you're not going to find a really, really good coach at a bank. If you find somebody who's really good, stick with them, take their advice, listen to their advice. People who retire with 30 years of financial advice retire with 2.5 times more assets than people who go through without advice for those 30 working years. Advice is hugely important. Got to be very careful who you get it from. So that's it for this part of the presentation. I would like to take some time to talk about credit scores. Before we do that, please come off mute and ask me any questions relating to RSPs, TFSAs, taxes, anything that's top of mind for you here before we get into credit scores, how to build them, how to repair them, how important they are for a lot of different financial transactions in Canada.
Okay, please use the raise your hand feature so that I can call you one after the other and multiple people are not trying to speak at the same time. Okay, I see Damara's hand pressed. Damara, please go ahead.
Go ahead.
Thanks for the presentation. I have a question. Can you please expatiate more on the credit union? So
Sure.
Is that like institution like, say, for instance, RBC, or it's like a group of some class of financial institution? You can shed more light.
Sure. So banks are a good representation of a bank where they're publicly traded. So you can purchase the share of a bank on the open market on the TSX. That would be RBC, TD. There are a number of independent financial institutions out there as well, like Raymond James, Edward Jones, that sort of thing. Those guys are all publicly traded. Those guys are all trying to sell product to earn a good return, to pay their shareholders that can buy their stock on the TSX, the public market. A credit union, and there are a number of examples. There's Meridian Credit Union, there's Libro Credit Union, there's the United Teachers Credit Union. Credit unions are structured very differently. You need to become a member of the credit union to utilize their services. We provide all the same services as RBC, TD, that sort of thing. You can invest with us. You can have your mortgage with us. You can get great advice. You can do all that, but you pay a nominal fee. Quite often the membership shares are subsidized. To be honest with you, most of them are $5, $1 for your membership fee, but you become a member of the credit union and you're becoming a member of a cooperative. Okay, there are a number of cooperatives out there that aren't in the financial space. Some of those would be Gailey Foods. If you see them in the supermarket, they're a cooperative. There are a number of cooperatives. Home Hardware is one. There are a number of cooperatives out there where instead of earning money and providing the benefits of that earned revenue to somebody who bought your stock, that earned revenue benefit goes back to the people that utilize your services. So with the credit union, you get about $1 for every $1,000 in business you have with us. I have my mortgage with Libro Credit Union. I am a member, not just work there. My mortgage, being very personal here, it's about $300,000. I get paid $300 for having that business with Libro every year. They're not paying somebody who bought Libro stock, because we don't have Libro stock, out that $300. They're paying me for having my business with Libro. It's a different approach. It's a different structure. It also, the most important piece I want to drive home here is the structural difference allows us to spend more time coaching, more time educating, more time supporting, and driving home concepts and strategies and plans to help you guys with your financial goals. That is the driving force behind what we do. That's how we outcompete our competition. That is not the focus at most other financial institutions, because it can't be. They got to do more volume. They got to see more people, and they have to sell more product. Did that help?
Damilala, did that response help?
Yeah, that helped. Thanks a lot.
You're welcome.
Okay.
Yeah.
All right, Precious, please go ahead. Precious, you're on.
Here we go.
Okay, so my question is, well, first and foremost, I want to appreciate you for the wonderful eye-opening. It's really eye-opening for us to know sometimes ignorance just puts you in a very bad position.
Yeah.
So I wanted to know, is there a limit for the use? You made mention of the limit for TFSA. I was wondering, is there any penalty for paying above or below what you should pay for a TFSA in a given year?
Good question. If you over contribute to your TFSA, you will get charged by the government, who does track and monitor the contribution limits for both RSPs and TFSAs. The charge that you get is 1% of the total amount that you've over contributed by in your TFSA. So if you over contributed on your lifetime limit by $2,000, you're paying 1% of that $2,000 every month moving forward. Okay. That's a very good question. It can get tricky because you can open up multiple TFSAs at multiple different financial institutions. So you have to be very aware of what you've contributed over the lifetime to all of those different TFSAs if you have multiple. If you need help with that, what we end up doing is we check your MyCRA. Your MyCRA login will have exactly what your TFSA remaining contribution balance is, along with what you can still contribute to your RSPs. So that's the best place to go and find out exactly what your remaining contribution amount is. You log into MyCRA.
Okay, thank you. And
You're
the
welcome.
second part of it was, if you pay less, do you get any penalty for paying less?
If you
Do you get penalized for paying less than your expected TFSA?
No, you don't need to, you can make a $1 contribution to your TFSA, you can max out the whole amount. There is no difference in, there's no penalty, there's no issue at all. Quite often with most people, I tell them, start a habit to start contributing to your TFSA. If it's $25 biweekly and you're not going to miss that $25, you're starting a really good habit of contributing to a really great program, and then invest it within that. But there's no penalties for under contributing. There is that 1% for per month for over contributing, just by the amount that you've over contributed. Good
Okay,
question.
thank you so
Welcome.
much. I will leave others to ask questions, but if there is no other person, then I will ask my last question.
Perfect.
Thank you.
Okay, thank you so much. So Precious already asked my first question, talk
Okay.
about the penalty about over contribution. My second question is just a general curiosity as to what kind of marketing do the credit unions do? Because it seems like like you said, the larger financial institutions need the volume, so they need to do that marketing. So
Yes.
do you, broadly speaking, do the credit unions do anything to get themselves out there, to know what's available to prospective customers? That's
So-
what I wanted to ask.
That's a really good question as well. It depends on the credit union. Every credit union has their own specific mandate. It also depends on the province. I will say this province in Ontario is the headquarters of all the top 5 banks. So all of the top 5 banks have a headquarters in downtown Toronto. They have wonderful market penetration in Ontario. They don't have the same presence in Quebec or BC, for example. Okay, out in BC, over 50% of the market share is with a credit union. In Quebec, it's potentially even higher. They call them case populaires in Quebec, in French, and the banks are not as prevalent or popular there as credit unions. So if you're out in BC, you've got all the, and you're Van City, let's say, which is the biggest credit union in the entire country, Van City directly competes with the marketing campaigns of the banks out there, because credit unions, more people bank with credit unions out in BC than they do with the top 5 banks. Difficult to do that here in Ontario, and it also depends on the mandate. So if we're looking at the largest credit union in Ontario, which is Meridian Credit Union, they're looking to compete directly with the banks. They really are. They're looking to grow. They're looking to become as big as they possibly can. With other credit unions, they were set up for a specific purpose. So there are teachers' credit unions that want to serve teachers and their families, and they're happy to fill that mandate and that role and provide all of the great benefits of being with a credit union back to that niche. With Libro Credit Union, we've said Southwestern Ontario is our area. We're not looking to expand beyond that. We don't want to be downtown Toronto. We serve a lot of agricultural communities, smaller towns, and our focus and the way that we go out into those communities is to say we want to serve these communities. We want to get to know the community groups that are in our areas. We want to volunteer. It's actually a really big part of who we are as Libro Credit Union. Our focus is growing prosperity in Southwestern Ontario. It's not a big, broad mandate, we want to be in our communities. We want to be serving them. We want to be supporting them, not just with financial knowledge and that sort of thing, but we've said we want to volunteer our time. We want to get to know the people that we're serving. We want to be immersed in our communities. And that is how we're trying to elevate and raise awareness about credit unions, is doing things like this. You have a community group that wants to learn more about financial resilience. We want to be the ones providing that support and coaching and advice within our communities. And we've got the time to do that because we're not trying to be everything to everyone. So it's a very good question. It depends on the credit union. Some of them are directly competing with the banks, and others are saying the way we're going to compete is we're going to be in our communities, immersed in them. We're going to volunteer our time. We're going to get to know people. We're going to know your name when you walk in. We're going to answer the phone within the first 3 rings, and we're going to know who you are on the other end. And we're going to provide excellent service and coaching and advice and support. So
thanks, Braden. Very, very interesting business model. And I wanted to ask if we have 7 more minutes technically, and I don't know if you have the time to spill over. Do you want to talk about the credit system before you take more questions? Because I know Precious has one more question,
sure.
And there's one more question in the chat. So how would you like to do that?
Give me 5 minutes with the credit system. It's very, very important to be knowledgeable about this in Canada, and I can do a lot with 5 minutes here, and then we'll open it up for some more questions. Now, I want to respect your time. I won't present past 5 o'clock here, but I'm happy to stick around and address any more questions if you guys think that's valuable. So
excellent. What do we think, everyone? Thumbs up if we're in agreement. Okay. All right. Proceed, Braden. Thank you.
Sounds good. No worries. Let's get as much out of credit scores as we can. I'm going to take it a bit quick here, so I apologize in advance. What is a credit score? A credit score is a 3-digit number ranging from 300 to 900 that gives a lender a snapshot of your financial health at any given time. Lenders use information from your credit report to compute a score that will indicate the probability of you becoming delinquent on your loan. The higher your score, the more likely you are to make payments on time, and your credit score helps the lender determine how much you can borrow and what the terms will be. So really important to unpack that. Having a good credit score not only allows you to get access to financial products like mortgages, car loans, lines of credit, that sort of thing, which can make your life a lot simpler and easier. But it also determines what the terms will be. If you have a low credit score, you're going to pay more interest in most cases. Having a high credit score not only allows you access to a broader range of products that will help you be more financially successful, but it gives you better terms. You have lower interest rates. You can extend it over a longer amortization period. There's often more flexibility. A high credit score is very, very important. Now, credit scores are compiled by companies like Equifax and TransUnion. They're the ones that provide your 300 to 900 score to all financial institutions, along with pretty much everybody who you would look to borrow from. Car loan providers at the dealership, cell phone companies, that sort of thing. What makes up your score? Very important. 35% is based on your payment history. The biggest chunk.
Excuse me, Braden. Are you sharing the screen?
I am, I thought. Let me stop sharing and let me start it up again.
Okay, yes. I had that feeling you were sharing your screen. But we see the TFSA.
Can you see this now?
Yes.
Okay, sorry. Here we are. Sorry, I just switched over from the PowerPoint presentation to this guy, and I don't think it carried over with me. 35% is based on your payment history. That is the most important component. If you miss a payment, it's going to take you 2 years to catch back up on your credit score. It will impact you for 2 years. 30% is based on your capacity. What we mean by capacity is how much credit do you have access to when you look at your credit cards, your line of credit, all that kind of stuff. How much do you have access to versus how much you're using? Here's some numbers to keep in mind. If you're below 75% of your credit limit, you're improving your score. If you're below by 50%, or you're only using up to 50% of your credit utilization, you're improving your score even more. If you're above 75% of your credit utilization, you're going the opposite way, okay? This factors into things like, I've paid off my credit card and I have a zero balance on it. I feel really good about myself. That was a really hard thing to do. I'm going to close that credit card because I don't need it anymore and I don't want it to be open, but maybe it was a $5,000 credit card. I would recommend, based on that knowledge, don't close that credit card, because having a 0% credit utilization on that 5,000, that will help you with your whole file, and it will help you reduce your negative credit score, improve your credit score over time. Leave that credit utilization open so that it's improving your credit score, okay? There are little nuances like this that can really help repair a credit score or improve it, or establish one. 15% is based on length of credit. So if you have another reason why it might be a good idea to leave a credit card open, if it's your longest form of credit. There's 10% is based on accumulation of debt in the past year to year and a half. This includes inquiries. So you get dinged on your credit score if you make multiple inquiries at multiple different places. It's considered credit seeking behavior, and it could negatively impact your credit score. 10% is based on a mix of credit. Do you just have credit cards, or do you have credit cards and an installment loan, or a car loan, or a mortgage, or, you know, the variety of credit that you have available to you and you're accessing and using can also either improve or detract from your credit score. What doesn't affect your score? That's debt ratio, income, length of residence, length and type of employment. What will hurt your score? Missing payments, accessing your credit cards, closing your cards, shopping for credit excessively, opening up numerous accounts in a short period of time, having more revolving loans than installment loans. A revolving means something like a credit card where you just pay off the interest. An installment loan is something like a car loan where you have a set monthly payment to pay it off and an end date. And borrowing from finance companies also hurts your credit score. Finance companies, those are the on the corner payday loan type of place. How to improve your score? I know it's 5 o'clock. I'm going to finish this off quickly and then we'll get to the questions again. Pay down your credit cards and try to keep the balance below 75% of your available credit. Continue to make payments on time. Slow down on opening new accounts. Too many inquiries may indicate financial difficulties or credit-seeking behavior. Ensure information on your report is correct. It's important to check your credit bureau at least once a year to make sure a number of things, but primarily to make sure that your report is correct. And if you're shopping around for a car or mortgage, try to do so within 2 weeks, as they will group all of those inquiries together and make it look like it's one inquiry, so it doesn't hit your credit score and look like credit seeking behavior. So if you're going out to buy a new car, don't spend 6 months, working with dealerships back and forth. Try to keep that within a 2-week window. Do your research beforehand, then go out and intensively shop. I'm going to open this back up for questions about any topic that we've covered so far today.
Okay, I'm just going to revert back to Precious because she had one, and I think Fidelia has the question, then we can take it forward.
Okay.
So Precious.
All right, thank you so much again. My question, one of it is the lifelong learning. And if you borrow from it, I saw you said it's you can pay off within 10 years.
Yes.
So do you really have like a fixed amount you can borrow? Is there a certain amount? Is there a limit to what you can borrow from your RRSP?
Up to $20,000 from your own RRSP. That's the limit of what you can pull for the lifelong learning supplement from the RRSP. And then you pay that back over in equal installments. So let's say you take the max, it's 20,000. You have to pay that back to yourself over the course of 10 years. That means the maximum your payments are going to be back to you is $2,000 per year.
Okay. All right. Thank you.
You're welcome.
Okay, there was a question from the chat. It says, how do we become a part of Libro family? Shareholders in bracket, parentheses.
Right. So we call you, we call even the people that work there, because we all do our business there. We call them owners. A lot of credit unions will either call you an owner or a member. To come in and become a member or an owner of a credit union, you just go into a credit union or do some research online beforehand to find one that you think that would be a good fit for you. You go in and you say, I want to become a member or I want to become an owner. With us, right now, we are subsidizing the membership shares. So if you go into a Libro credit union in your local area, you would open a bank account utilizing a process that is almost identical to what you would do at a bank, because we all have the same regulatory requirements that the government puts on financial institutions to open that. So you need your social insurance number and a government issued photo ID, and you come on in and you have a conversation with us about what type of bank accounts do you have and what your financial goals are and what you need. Outside of the regulatory requirements, it will be a different experience because we're going to ask you a lot more questions. Please don't be intimidated by that. It is not designed to scare you away or to make you feel self-conscious or uncomfortable. What we're trying to do at a credit union is different than the banks. We are trying to get to know you, and it is genuine, and we are trying to help you with your financial goals. We can't offer you product or anything like that unless it's matched to a need that you have. So we are going to ask you more questions than you probably have been asked when you go to open up a bank account at RBC or TD or BMO, mostly because we want to help. So that is something to look out for. You will get more questions. The regulatory requirements are the same. Our product shelf is very similar, but just go on in and start a conversation, ask some questions. I think you'll also find that, you know, you're not going to get a lot of pressure if you walk into a credit union and you just want to learn more about it. Nobody's going to try and sell you a product or get you to open an account that day, but they will want to talk to you about what it means to be a credit union and want to learn more about you. Pardon me. Sorry, guys.
Okay, thanks.
I've been talking for a while.
Yeah. Gamlala, please go ahead.
Okay, 2 questions. So on your screen, I just want you to explain on 1, debt ratio. Then my second question is, as regard closing credit cards, does this include credit card, like let's say you have like Walmart's credit card and all this, you know, credit card? What's the effect of closing those types of credit card as well? And my third question is still on your bullet point about having more revolving loans than installment loan. Can you please differentiate between the two? I'm not sure I understand what those type of loans mean. Thank you.
Absolutely. I'll start with the first question here. Debt ratio. That's something that doesn't affect your credit score. That is basically the same as saying income doesn't affect your credit score. When you go to get a mortgage at a financial institution, they will look at your debt ratio because there's regulatory requirements that we all need to fit into as well as lenders. It means that what is the amount of debt you have versus your income. Another word for debt ratio that you may come across as you're going for a mortgage is called your GDS and TDS ratios, your gross debt servicing and your total debt servicing. How much of your income is going to paying down debt, okay? Which includes everything that would be in your credit bureau. So mortgages, lines of credit, installment loans, car loans, you add up all your monthly payments together, What's the percentage of that compared to your income? That's your debt ratio. That debt ratio doesn't impact your credit score, but it will have an impact on, let's say, a mortgage application, okay? Your debt ratio needs to be below certain thresholds for GDS and TDS. GDS is gross debt servicing. It talks that's just what's the ratio of how much you're paying that goes into housing. So if it's rent, it's your rent and your heat and hydro. If it's a mortgage, it's your mortgage payment. It's potentially condo fees, but it's not your TDS, which is total debt servicing, which includes all the stuff that you're paying directly for your housing and your car loan, your monthly payment on a credit card, that sort of thing. So debt ratio does factor in when you're looking at a mortgage and a lending application process, but it does not have an impact on your credit score, okay? So credit score is purely about your history of repaying and how much credit you're utilizing, how much do you have access to versus how much you're using. Those are the things that goes into your credit score and rebuilding your credit score. It does not factor in your income. Next question was, yes, your credit cards that you have through, let's say Walmart, that sort of thing, if you've paid them off and paid them down, but you still have access to, let's say it's a $2,000 limit on your card. If you have another card maxed out at $1,500, but you have this other card completely paid off, that 2,000 there means you have 3,500 in available credit and you're only using 1,500. But if you get rid of that $2,000 credit card, you have available to you $1,500 and you're using 1,500, which means you're above that 75%, and your credit rating will go down every month until it drops below that 75%. So you could think that you're doing the right thing by paying off a credit card and completely getting rid of it, but it may still have a negative impact on your credit rating if you're near the max on another form of revolving credit, like a line of credit or a credit card. Now, I forget, after those two explanations, what your third question was. Can you repeat that for me?
Yeah, sure. So the third one was about revolving loans and installment loans.
Okay. So when you look at your credit bureau, it's going to have an R or an I or an O next to it. So it's revolving, installment, or open. Revolving credit, a good example of that is either a line of credit or a credit card. You don't take the, let's say you've got $5,000 limit on your credit card and you use all of it, and you don't split that up into a monthly payment that will pay it off over a set time frame, like 3 to 5 years. What you're doing is you pay the interest accrued on that monthly. Minimally, you have to pay the interest. If you want to pay more down to reduce, you have to pay more than the interest. That's revolving credit. Another way to think about it is, as you pay down money on your credit card, you can continue to use it. So that's what the revolving piece means. You can pay it down, you can add to it, you can pay it down, you can add to it, you can pay it down, you can add to it. That's the revolving credit. So that helps me remember it. With an installment loan, think of it like a car payment or a mortgage. You take a car and you put a little bit down on it, but it's worth $20,000. You take that $20,000 and you divide that by a 5-year amortization, and you split that up into monthly or biweekly payments, and that's your installment loan. You know exactly what you're paying with every pay period or installment. So instead of paying it down and adding more to it, paying it down and adding more to it, like you do with revolving credit, you take that whole loan, you divide it up by 5 or 7 years, and you know exactly what you're paying with each installment. So that's the difference between installment and revolving credit. The O for open, that's very similar to a line of credit or a credit card as well. It's just another way of talking about that. what the point was making here is credit bureaus, financial institutions, we are all less comfortable with revolving than we are with installment. So if you have a mix of both, that's good for your credit score. If you only have revolving access to revolving credit, it could have a negative impact on your credit score. Installment loans are looked upon favorably, whereas revolving credit, not so much.
Thank you, brother.
You're welcome. Did that, do you have any outstanding questions with that left? There was, I think, a lot of ground to cover, and I don't know if I did a good job with all of it, so.
Oh, you answered my question. Thank you.
Good.
Thank you so much, Braden. Everybody, thank you so much for your questions. I think you did a very fantastic job breaking down some concepts. I do have one question before we wrap things up.
Sure.
So for a lot of newcomers trying to get housing, maybe you either speak to a real estate broker, or more popularly, people go onto sites like Marketplace, Kijiji, to look for housing. And then you find prospective landlords tell you, they ask you for a number of things. And what they also ask for a credit report.
Yeah.
So my question is, how do you go about getting a credit report, and how does that affect your score? Does that relate to an inquiry? Personally, I find that a little confusing. Yes. So if you could answer that, that would be great.
Okay. So dealing directly with Equifax or TransUnion, these are the people that their job, their business model is to compile all this information and have the credit reporting available for financial institutions to pull, so that it helps us make decisions on loans and lending and that sort of thing. But we have to pay for it. Okay. So that's their business model. They compile everything together. If you want to pull your credit, you can go directly to Equifax or TransUnion. Those are the two big ones that we all use. And you will get a credit report. When you ask for that yourself, not through a financial institution like where you're looking to pull credit to potentially do a car loan or a line of credit at a bank or a credit union, if you do it yourself, it does not count as an inquiry. Okay. If you go to 6 different financial institutions over the course of 3 weeks, opening accounts and trying to access credit, that will count, and it will hit your credit score, because it will look like multiple inquiries over a longer period of time, and it will have a negative impact on your credit score. If you go directly to Equifax or TransUnion, and just to get a better understanding of your own credit report, that is completely fine. It does not impact your credit score. What I would do before handing your credit report over to a landlord, because they're using that to make a decision as to whether or not they want to allow you to rent from them, I would take your credit report into a credit union. We're going to pull your credit when we open an account for you the first time. We can't give you the credit report, but we can absolutely review it with you and let you know, here's all your trade lines, here's your score, here's what's benefiting your credit score month over month, here's what's hindering your credit score month over month. I would have that conversation with somebody in finance that you trust before I started accessing my credit report from TransUnion or Equifax and then starting to hand it out. I really would have that conversation, so you know how strong it is. Is it detracting from your application to that rental unit, or is it supporting? And if it's detracting, how do we get it to that place where it looks really healthy and where people want you to rent from them? How do we get there as quickly as possible? So Equifax and TransUnion, you can access it yourself. You can go to their website, you can request it. If you are having difficulty working with Equifax or TransUnion, because many people do. They're not super easy to work with. Go into a financial institution as well and ask for help with accessing your credit reporting. We would be happy to help.
Thank you. Just one last question. So someone said, what about new immigrants who don't have any credit reports in Canada? I mean, I'm thinking the person is asking how they would be able to navigate the system without having a credit report.
Yeah, so you will have a credit report. When you first come into Canada, you will end up having a credit report. Now, your credit report will be, it will not be a thick file, which is the lingo that we use to say it's an established credit report with years of history and multiple trade lines and all that sort of thing. The good news is everyone that starts without credit, let's say it, because it's the same thing for kids that turn 18 and start accruing a credit history for the first time in their lives. At that point, you start with no credit history. When you start with no credit history, your score is called A paper. It's not the highest it can be, but it starts at a really, really good level. So that's the good news. The bad news is, because you're starting at a really good level, but you don't have a lot of factors that are influencing your credit, it can either go down really quickly or it can go up really quickly. So once you start accessing your credit, it is important to be doing that correctly and well, and making sure 35% is based on your payment history. Make sure you make your payments. Number one, keep your capacity lower than 75%. You're going to have a couple of things that negatively impact your credit when you're just establishing it, which is, you know, the amount of inquiries to get things set up might give you a hit. The accumulation of debt within the first 12 to 18 months could hit that, which means everything else has to be pretty good to maintain a good, healthy credit rating. Did that help address your question? And if you are brand new and you're having trouble accessing your credit, again, I would recommend that you go in and speak to somebody that you trust, and we can help you with that process. Sorry, guys.
Okay. Very good. Okay. Thank you very much. It's 5:19. We are way past over, but I think that Braden has done a fantastic job of breaking down this seemingly ambiguous yes, and you have buddy. So, but thank you everybody for joining. Thank you, Braden, for taking the time to share all this with us. I believe that we've all picked one or two things, you know, to think about, and we're going to start implementing to, you know, to get our finances on track and build that resilience we're looking for. So thank you, everyone. We will find a way. If we want to reach out to you, how do we contact you, Braden?
I was just going to ask you that. I would love to send out my contact information.
Okay.
Just if I could do that, if I could give that to you, and then anybody who wants to reach out to me, they can ask my questions. Again, my purpose here is not to sell you on anything, but if you do have questions, if you do want to dig a little bit more into your credit bureau, that sort of thing, please reach out to me. We'd be happy to help. I'll give you my contact information. You guys can do with it what you want. Okay, we'll be happy to receive it. Lovely. And for someone asking about the recording, it would be uploaded onto the website, and we will communicate that to you in the group when that's been uploaded. Okay. Okay, everybody, have a good evening. Enjoy the rest of your weekend. Bye, guys. Thank you for the time. Yeah.